All right. Well, great, Scott. Good to connect with you. Thanks for taking the time. You and I have known each other throughout the years, but hadn't caught up until recently. So it's fun. I think that the email I sent to you was
Nothing's
blast
changed though, right?
was bl
Over that time.
was I, I guess I called it blast from the past, right? And I think when we were, collaborating pretty directly, it was a decent size past ago, right? I mean, the breadth of what you're doing has changed. My employer has changed. Now I'm with the Instant Group. Um, and obviously our core constituency, one of the constituencies we share is landlords. And their world has certainly changed since we
Sure.
started
Yeah.
collaborating. So it's safe to say that we're in the middle of one of the largest transitions in the history of the office market, probably most pronounced in the country where you and I both live in the United States. Um, how would you describe the changes from where you sit, you know, having a broad research role across property types in the Americas?
Yeah, Ben. So obviously the magnitude of change that we've seen over the last few years has been nothing short of astronomical, even. So the demand disruption for office space, starting with COVID, was something that we've never seen anything like it before. 274 million square feet of occupancy losses within the United States. Vacancy rates now at an all-time record high. Everyone is trying to figure out this hybrid work thing, which there was a bit of experimentation with it beforehand, certainly, but this ubiquitous remote work, video conferencing, agile work strategies, and the needs to plan around these waves of peak occupancy and underutilization and solve all of these problems that seemingly kind of popped up overnight with COVID. And, certainly flex being an important component of the overall office ecosystem, in many cases, a microcosm of broader office market demand, has seen its fair share of changes as well. And, you set aside, and just the supply and demand fundamentals within the market, and you also then look at the interest rate environment and this, again, unprecedented time that we were experiencing there in the, call it 2015 through 2019 timeframe, when we saw this explosive growth of the sector, which corresponded not just with zero interest rates, but negative real rates in many countries throughout the world, the US included at that time. And the amount of just risk investment that we saw really, across the spectrum. You saw the largest pool of risk capital that was ever created in the SoftBank Vision Fund, and so much of that, about a fifth of that was targeted on just one entity. So, it was a crazy time for the office market even before the pandemic. The pandemic has made it even crazier. I do think that the dust is settling a bit, so that you can draw some conclusions around, where are we point in time right now, and where are we likely headed over the intermediate to long term, where finally I feel like a lot of our larger corporate occupier clients feel like they found their footing. They can make some longer term space decisions. There's more activity. Based on the most recent quarter, Q2 of 24, leasing volume, we're 90% of the way back to pre-pandemic levels in demand, which I think is a great step in the right direction. These employers, in most cases, have finally solidified their workplace strategies and their expectations around the amount of time that employees are expected to be physically together. I think that we're certainly obtaining, I think, a lot more clarity and certainty in the market. And 2024 right now is all about visibility and enforcement of those policies that took a long time to bake, took a long time to get initial compliance, and now it feels like the office market is not fully back on track, and landlords, certainly in dealing with the issues around loan maturities and a dramatically different interest rate environment, still have a long road ahead of them. But it feels a lot better right now than it did a year or two ago.
Yeah. So next question I want to talk is about occupiers. So I was
Mhm.
talking with the woman that really leads our client group at Instant in the Americas about what's going on with occupiers. And obviously the type of demand that we see is typically for, serviced or co-working, but also small single tenant offices. And she and I were looking at some of the sales numbers and the demand numbers that Instant sees, which are significant, and trying to figure out the behaviors that we see from occupiers. So I'm going to throw some things out to you, and I want to get your reaction with what you're
Mhm.
seeing largely among corporate and traditional occupiers. So number one, the types of space that occupiers are looking for is changing. More meeting rooms, even fractional kind of types of things, um, things of that nature. Another thing is just the simple, man, it's taking a long time for occupiers to make a decision, and that's impacting how this goes. The next is actually something you've brought forward is competition from different, call it vintages of space. You've got space you can build out yourself. You've got pre-built space from flex or co-working operators. You've got a massive amount of sublease space, which your research highlights. So you've got these different kind of confusing offerings. Um, and then I'd say fourth is just the real acknowledgement among occupiers that they have leverage with pricing, right? So of those kind of collection of occupier preferences, which stand out to you as things that are driving decisions, knowing you know, overall activity is at 90% of pre-pandemic levels. What they're looking for and how they're behaving is probably still quite different. So I'm interested in your take on it.
Yeah, I mean, I think that you hit on so many of the important variables that are driving site selection and space decisions. And I think if you were to really generalize what is defining activity right now, it tends to be less space, better place. So tenants that are adapting to more remote work, and the fact that there is a lot more visibility and precision around underutilized space. I mean, people are looking at Placer AI for the cell phone tracking. They're looking at IP logins. They're looking at badge swipes. I mean, we have a financial services client who said that there are 75 different data points per day per employee that they're picking up on the whereabouts of their employees, kind of when and where they're working. So it's almost like there's too much data, and there's probably, unfortunately for the industry at large, the data is suggesting, generally speaking, that there's still too much office space. And we love the examples. Like there was the Tesla Fremont office where they didn't have enough parking spaces and didn't have enough chairs and desks. And it's like, oh yeah, this is going to be everyone, as if everyone's pulled back. But the reality is that tenants are still generally cutting 15 or 20% of their footprint if their headcount is remaining more or less stable. They want to go to a better building, whether it's newer and a better location. Rental rates really haven't gone down much, and part of that is just what's financially possible given loan covenants, without getting into too much arcane general office stuff to stay more on track. But it's the tenants want employee experience. They don't want return to office to just feel like a mandate. They want the office to be a magnet. They want to have services and amenities. They want to draw people together and really capitalize on those opportunities when everyone is in the office to be learning and growing together, providing mentorship opportunities and doing all those things. So, I mean, quality is a big piece of it for sure. The other piece, just given the realities of the market, is just the ability to transact, and that's something that we've certainly heard from our corporate users within flex spaces, where there may have been, some displacement risk. The operator is not paying their rent, like they're hearing that, and it just is creating a lot of anxiety. The same thing happens for direct leases as well, where, the tenant is used to facing some credit scrutiny, but now the tenant is looking at the landlord and saying, is this landlord going to be able to fund deal costs? Are they going to reimburse for these build outs? Can they actually transact? Are they going to get lender approval where they need to? So it's a really challenging time. I mean, you hit upon it, just the deals are taking longer to get done. Part of it is there are more options. Part of it is that certain landlords, aren't even sure whether they can transact at the end of the day. And it's been dragging things on a bit, and the tenants, for their part, sometimes are getting cold feet right there at the goal line, because it's still feeling like you're shooting in the dark when it comes down to what truly are those space needs. How do you marry the needs assessment with the physical space? Are you being correct in your assumptions around the allocation of personal workstations relative to communal and collaborative spaces? And it's a lot to absorb. It's a lot to model in. Real estate decision makers tend to be some of the most risk averse people out there. They just don't want to make a mistake. So all of those things can create some challenges, but there's a segment of the market there, and it's really that super premium kind of top of the market that's never been better. I mean, we're seeing record rents for trophy developments in gateway cities and mixed use developments in Sunbelt markets. I mean, it's like rents in Miami in Brickell have doubled or tripled in some cases. So you definitely still see, I think, really encouraging signs, but at the same time, there are even more examples of distressed sales and some of these assets that are coming to market that are transacting at a 70 or 80 or even 90% drop in basis. And it's just kind of like, it makes your head spin.
So you said something to me during COVID. I think it was early, where you said, look, the drop in demand, at least a per square foot per person demand, has been something that's been happening for decades. And you used an example of, hey, a law firm doesn't need a big file room like they might have, or a big training room like they might have. Hearing you now reminds me of that conversation, where it's like, hey, we're kind of at 90% of where we were from a demand perspective pre-COVID, and we're looking, tenants are looking for smaller, nicer space. So are we getting back to the trend that you pointed to kind of pre-COVID? Like, look, this has kind of been going this way for a while, or is it still an anomaly? Are we still in something new, I guess, is the question.
Yeah, I mean, it certainly exacerbates that trend that we had seen previously. So this is my 20th year at JLL. And the first 10, I feel like it was so easy to forecast demand for office space. You looked at every professional and business services, financial and information job that was created, and then you multiply by 175 square feet, and then voila, that's going to be your demand.
Easy math.
12 months
Easy
down.
Math, Scott.
Yeah, easy arithmetic. But that was also the time that we were all logging on desktop computers, and we all had phone lines that were sitting at our desk. You didn't have. It wasn't a grab your laptop and go, and as long as you have a seat and a strong Wi-Fi connection, then you have a workplace. And it's really for that reason that you saw, even before the pandemic, that ratcheting down of the square footage per new job that was created, including even going negative in some markets. So you were still creating jobs, but you're seeing negative net absorption because there was so much inefficiency that was built into into the office space environment there. So, right, I think you throw hybrid into the mix as well, and it's just one more of those challenges there. But something that you really don't hear a whole lot about, and I'm not really sure. It seems like we're in a bit of a pivot point of where we could potentially be moving. But consistently, you look at what an average organization spends on real estate relative to their the cost of their people, their human capital, their salaries that they're paying, and it's about a 10x. And the satisfaction surveys find generally that the most valued feature of office space is the amount of space that's allocated per person. So you can kind of throw aside some of the bells and whistles around the fitness centers and rooftop terraces and all these other things. People want a large dedicated space for themselves when possible, and that drives a lot of the employee satisfaction. And when you kind of hyper compress some of those spaces, when you move away from dedicated workstations, then I think you jeopardize, that whole push-pull mentality around, are you creating the optimal workplace for your employees, or are you just trying to value engineer and ensure that you are being absolutely as efficient as you can? And I think that that's also factoring into that equation. So are we going to see a point in which you do see a reversion back to that longer term historical mean of X square footage per job, and that starts to expand? Maybe we will, but there really aren't many organizations out there that are adopting that mentality. Sure, like that they're right now they're putting in premium coffee machines and they're looking towards other amenities, and they're looking much less at the actual square footage per person, but that may change.
Yeah. All right. So to tie a couple things together, there's obviously a trend that was happening before COVID towards less space. There's also obviously a massive disruption and a massive change in thinking among occupiers. So investors and owners who've been in the market for some time may see this as kind of just another cycle, right? And some of the behaviors you and I witness are related to that. It's, hey, we've seen this before, we'll ride it out and it'll come back. So the question is this just another cycle, or is it a structural change that will really impact demand for the long term? How do you see it from this point in time?
I think it has to be a combination of the both. There are just structural changes in demand, and that's something that the market will need to adapt to. But there's also the cyclical component that was really, catalyzed by the sharpest increase in interest rates that we've ever seen. They're starting in the spring of 22. So, when you have an office investor who is carrying a building with a 3.5% loan that then expires, and you're trying to roll that over, and all of a sudden it's 7.5, or it's 9, or it's 13, or it's just not financeable at all. That's the game changer right there. And that it's really anyone's guess whether that's going to be a cyclical thing. Are we ever going to get back to the point that we were before there? And that just it underpins the health of the office market from an investor's perspective, irrespective of whether the demand is back to 90% or 100% or 110% of where it was. Because not only do you need to get back to where you were, you need to be then you need to have sufficient pricing power to drive rates to the point that your that your net operating income still pencils out relative to the cost of debt. So, I mean, it's a double whammy for the market. I think that there's certainly a cyclical component to it, and that element has been moving generally in the right direction. There's broad expectations for at least a 25 basis point cut in the funds rate in September. Maybe 50. I think the yield curve is pricing at about 50 right now. So that's all going to be good news, but there's still more work to be done for sure.
Yeah. So speaking of that kind of mindset, right? When you came out with, and your colleagues at JLL came out with, hey, 30% of the office market will be flexed by 2030. It was largely based on occupier preferences, right? And as I recall, you surveyed many corporate occupiers that JLL works with. Now, however, for that to happen, the supply equation has to be there also, right? Because really what we're talking about preferences for different kinds of space that happens to be more expensive to build and more expensive to finance. So you know, how would you say in this environment we're tracking towards this number in the United States? And what segments of the flex market do you see making the largest or the smallest moves towards that
Yeah.
prediction?
Yeah, the famous 30% by 2030 talking point. And I think so it's important, I think, to just kind of set the table around what we mean by consuming space flexibly. Kind of what is flex? What does it mean? How are we interpreting it? And how are these tenants adopting flexible work strategies? And as we think about and define flex, it's one, pre-built. So there's a pre-built component to it. You're not locked into a multi-year lease. Think about the traditional 10-year warm lit shell transaction that a lot of tenants are forced to sign as they're entering a lease, and it may or may not have some sort of service component to it, hospitality or services that are being delivered in conjunction with that sort of space. And what we have not seen is the component of third-party operated flex space under the label of WeWork and Regus and Industrious, and everyone knows all the names of the various operators. There, a handy chart. Yeah, we have not seen
I love
the
your
growth
charts.
of.
So
Yeah.
we're putting it up here.
There we go. We have not seen those third-party operators kind of grow at an exponential rate that would in any way mirror what we saw during that boom period of 2015 to 2019, when there was just this flood of private equity and venture capital flowing into that sector. But when you think of the definition, go back to a pre-build and more flexible term component of flex, and you kind of open the aperture a bit to include spec suites, which a variety of landlords were even offering at a 3-year or 1-year term previously, and in many cases are continuing to offer it with the term. But obviously, it checks that pre-built box. That has continued to grow and show, I'd say, steady. Some steady expansion there. So if that was, call it 2.6%, I guess, where we were previously, that's likely to double by 2030 based on the continued growth that we're seeing there and the very strong tenant demand that we're seeing, as well as the fact that these landlords in many cases can offer a faster, better, more economical option building out the space themselves than providing a larger tenant improvement allowance, and then essentially having each tenant fend for themselves and trying to build these spaces out in a more bespoke way. And then sublease space as well, which really was a non-factor previously. I mean, we have one technology tenant that put in 2022 37 blocks of sublease space, over 8 million square feet, onto the market to backfill, and almost primarily Class A and trophy space. And you think of, WeWork's footprint at its height, I think it was 18.5 million square feet. So you have one traditional occupier that's putting half of the amount of space that WeWork had at their peak just up for sublease, and still retaining, by the way, the vast majority of their footprint. It puts into perspective, I think, just the magnitude of the issue. Its sublease inventory doubled from 100 million square feet to over 200 million square feet during the pandemic. And for better or worse, that is cannibalizing demand that would have otherwise gone into the WeWork large office product and some of the other suites that were geared toward those larger enterprise users. And the velocity, that's the part on the right of the chart that you put up right on cue here. You saw activity more than double from 2019 levels, and that's the 2019 levels is up from even pre-2019 levels. And the final piece of that is you roll in these expanded amenity spaces, which for landlords can be a no-brainer because you just roll that up and as a pass-through expense to tenants, but then you're offering these shared conferencing spaces, which may or may not be rationed and paid on a separate basis, but also larger tenant lounges and communal areas where that highly liquid mobile workforce can plop down with a Wi-Fi connection, grab a cup of coffee, and essentially, it serves as it's a great addition to the long-term conventionally leased space that they have. So, I think
Right.
we still get to that 30% by 2030 metric, but the way that you're doing it is a lot different. It's not the majority of that is not on the shoulders of these increasingly capital constrained third-party flex operators. It's more so on the backs of tenant controlled spaces through these subleases, and then what landlords are able to do directly through spec suites and expanded amenity spaces.
Yeah. I mean, this is a fairly important view for any co-working operator to understand, because I remember the read when this came out in late 2017, early 2018. A lot of co-working operators read, probably including WeWork, saying, "Look, we're off to the races. We've got a better product. We've got favorable interest rates. We've got demand characteristics that look good." Whereas now, 6 years later, we're finding that the pure play kind of co-working product, or at least your research is showing that, yeah, maybe a 25% increase, right? In that as a share of the market, but the remainder are among essentially how does the market absorb the sublease space, which is totaling 11% of leasing activity in 2024, and more to come. Um, Spec suites that are pre-built largely by landlords in the United States, and then amenity spaces that can be basically charged back to tenants. So this feels like a very different view than I think how the research was interpreted, at least by me and many others in 2018. But would you say this has been your prediction all along, or would you highlight is there anything really, really surprising in here for you, given that you originated the research?
I would say that the buyer preferences are very consistent with where those wants and expectations were when we originally conducted the survey around how is it, hey, end user, how do you want to be consuming space? Do you want to be forced into a 10 or a 15-year lease building out bespoke from a warm lit shell? Or do you want a pre-built option with shorter terms? And I don't think that the consumer has shifted, but I do think that the supply side and the delivery of space has profoundly shifted. And I mean, in ways that I think really no one was anticipating after 13 years of zero interest rates. And then all of a sudden, everything goes thud when you go from 0 to 5 1/3 over such a short period of time, and that the risk capital pulls back. So it's did things pan out exactly as expected? No. Are we hearing anything dramatically different from our occupier clients around their wants and needs for flexibility, though? Absolutely no. They've been consistent there.
Yeah. So moving on to talk a little bit about the sublease, or second generation space, which to me maybe has a more positive connotation than the sublease does. Many real estate professionals at JLL or elsewhere or at Instant have viewed that space as the hardest kind of space to market and lease, right? It's been kind of something to be avoided if you can. It's now so big as a percentage of the leasing activity that you just can't. So does this phase of the market necessitate that we look at this space differently, either in what we call it, like second gen space, how we package it,
Yeah.
or other things. So what are your thoughts on this kind of second generation revolution that's really kind of the foundation for flex space growth, according to your research?
Yeah, but it's probably an opportunity to coin a catchy new phrase for it, right? Because I mean, it's always been the stigmatized part of the market, that second generation commodity, um, vintage product, and what we've seen already, given a really abrupt halt in new construction groundbreakings, is a lot more activity that's trickling down. And I mean, the market has always throughout market cycles tightened from the top down. You've seen the flight to quality there, and now you're seeing a quantifiable increase in demand for what we're calling recently renovated product. And if
Oh,
you think
interesting
about,
positioning
well,
there.
I mean, it's not catchy enough, but and it does actually require some level of renovation as well. But that's done in pretty much all cases. So if a prime tenant is going into an asset and staying on average 22 years, then it pretty much necessitates that for the building to continue to be at least an A minus or an A asset, that there's some cosmetic enhancements, and you think about potentially upgrading the amenity package of the building. And I think that's where then within the competitive set of assets that a tenant would be out there touring, that you start to differentiate a bit. And that's where you start to see some leasing traction for that second generation sort of product. And I think that for just looking more broadly and where flex fits into the ecosystem, it's we have tenants and that have said in the past, we want to co-locate along with a flex operator, because we don't know
Hmm.
what our headcount is going to be. We're already actively involved in acquisition discussions. Our venture partners don't want us carrying a lot of long-term lease obligations, like for any variety of reasons. Maybe they want to take 20,000 square feet through a conventional lease, but they want to have that optionality to also then have some spaces there. And then for our landlord clients too, that have maybe been a bit more at the leading edge in terms of signing management agreements and been more open book with a flex operator, where they have more of a partnership relationship rather than an adversarial or competitive one, where they're incubating tenants into longer term, larger leases within the asset. There really there can and should be a symbiosis between the flex operator and the landlord. And I think that those existing assets, the recently renovated ones in particular, could find, I think, good opportunities to create an ecosystem that includes a flex operator and uses that to help activate some demand, and also serve either existing or prospective tenants with space that could be used for meetings and events or overflow, or whatever the future may hold for an organization, where you don't want to just be kind of caught in the trap of a long-term traditional lease and then all of a sudden have to make a pivot and be unable to.
Yeah. So we had a thesis, and are still working on a thesis that, hey, one way for the co-working industry to grow is to essentially backfill previously built out co-working centers. And we've tracked roughly 1,000, a little bit more than 1,000 in the Americas, mostly in the US. What we've been finding, some time into it, is that roughly a third of those have been kind of taken by a new operator. Roughly 15% of those have been either demoed or marketed to traditional tenants. So comparing this to pre-pandemic, when operators like WeWork represented, gosh, 5 to 15% of all leasing activity in the office
Mm,
market, and taking into account that landlords are, let's just say, they're not actively chasing, most aren't actively chasing co-working operators, even when they have a closed co-working center. What should co-working operators expect that landlords are going to essentially hold fast to require leases? Should they hold out for landlords to accept more and more management agreements? Obviously, it's going to be asset dependent. But what's your advice for a co-working operator who is trying to grow, has high occupancy, but is not necessarily finding a landlord to be hospitable to a management agreement?
Hmm. I mean, I think it would be great to see more management agreements. It would be great. But what don't we have? What do we need? What does everyone know that we need? We need a track record of success. You need transparency. You need the success stories to prove based on trailing income, rather than the way that investors and lenders have always valued office assets, which is on forward net operating income. But more like the hotel model, where you really know what the cash flows are for those spaces, and that this operator is going to hit their pro forma and is a trustworthy partner, and um, and that provides the clarity and confidence that you need to transact. I think that it, a lot of the groups that insisted on traditional leases with flex operators found themselves in a predicament anyway. So may have been better off to begin with and having a rev share and some sort of management agreement. It just seems to make a lot more sense for this to be kind of, to use the previous way I characterize it, but more of a symbiotic relationship between the
Mm-hmm.
operator and the landlord. The landlord, these are execution sensitive businesses. Everyone, who's going to be listening to this knows that it's probably way more than a landlord wants to take on for themselves. So it makes sense to be outsourcing the servicing of that space and the lead gen and everything that goes with operating space to a trusted partner. But the challenge right now that everyone finds themselves in is that there are capital constraints around who's going to fund a build out. The flex operators aren't swimming in cash like some were back during the VC boom there. I think there needs to be more of them. You need to have more management agreements. You need to have that track record, and I think that it will bear fruit, but it requires a leap of faith for sure. And it's lenders and landlords could underwrite a tenant with questionable credit before on a traditional lease, and somehow felt okay with that. But they really haven't, I think, really crossed the bridge into the whole management agreement dynamic. And I think there are still concerns around, is there going to be a hit to value if you do so? If you look at hotel assets, if you want to draw that comparison, and it's probably not a fair one because that's night to night rather than month to month or year to year, but it's usually a 200 to 250 basis point spread in an exit cap rate there. So, do you feel like you are conceding some value to sign a management agreement? You just need a longer discovery process, and you just need this to work. And I mean, I believe that it can work, but I think there just needs to be a greater level of comfortability with that, and more of those proof points around how is it that flex is really going to be accretive to the building, to a multi-tenant building overall, rather than just being this kind of piece of the fringe that nobody knows how to underwrite.
Yep, 100%. And we, along with some collaborators, have approached the ULI to build a product council called the Flex and Experience Council. So Jamie Simchick, Jacob Bates, Jorg Flikowski, who you may know at JLL, Stasha Anderson on this topic, and it's been fascinating to see the engagement from owners about it, who are among the most sophisticated investors and owners in real estate in the world, and there's not consensus around how to value this cash flow. So we're working on it. It's gonna, you mentioned the industry is risk averse. It's going to take some operating history, to get there. So last one, and it's we've talked a lot about occupiers, and one of the things you published in your research is the percentage of WeWork membership that is enterprise compared to non-enterprise. And you quote data probably from their filings that in 2020, 54% of all memberships were enterprise. And in Q3 2023, it was 41%. Do you feel like these numbers are indicative of corporate demand for Flex, or just more indicative of WeWork as an individual business?
So first of all, I'll preface in just saying that I think that for small and medium size and early stage companies, solo proprietors, Flex makes so much sense and will continue to make so much sense. And when you have whatever that magic number in headcount is, 12 or 15 folks, you always want to be in Flex, like without a doubt. But when you talk about the larger enterprise requirements, which grew, right, according to the public filings, into more than half of the revenues for some of these operators, that was at a time where there were lots of differences in overall market trends. First of all, sublease inventory was rock bottom, and if sublease inventory if the share of leasing volume in sublease inventory is more than doubled and kind of trending up, that just wasn't an option for a lot of users. And it's more compelling from a value standpoint. You have more identity over the space. If you're an occupier, you don't have to worry about any sort of security concerns. It's like it is the path of least resistance, and it is the most economically attractive option for an enterprise user. And I think that tables that sort of product. You think of the product SKU that a lot of the larger operators were building, where it could be suite 10,000 square foot suites in some cases, or full floors even dedicated to single users. And there's just no way to be based on where some of those leases would have been signed, high concession packages in the 2017 through 2019 timeframe. You're just so above market relative to where you would get a sublease for an even higher quality block of space. So it's like that, the tide has kind of gone out, unfortunately, on a lot of those enterprise use cases. You also just haven't seen, it's like these are the same groups that are putting lots of sublease space on the market were the same groups of yesterday that were some of the strongest adopters and customers of Flex too. So you also just have economic cycles there. Job growth, which is still positive for the country overall, has really scaled back in a lot of sectors, including tech, which was a strong adopter of Flex space. So when you think about some of those corporate flex space needs, which for us at JLL average 9 months in term, so not even a full year. It was a place to camp people out, typically before a longer traditional lease or entering a new market, and you're just ramping up hiring. There were a whole variety of use cases that were really evident in that 2017 to 19 timeframe that just aren't there to the same level right now. So I think it's at least kind of current and intermediate term that corporate demand is going to be pretty tepid. We all know now that flex operators need to turn a profit. These need to be sustainable businesses. You don't just have the same benefit that some of these operators that were VC funded had when they were still in their pre-profit cash burn phase. So I think that it's going to go back to the way that kind of things were previously, and that you're serving the core constituency of freelancers, solo proprietors, small, medium, high growth businesses that need that space, and that you kind of leave the larger corporate requirements to others. And I think that that's probably healthiest for the market overall as well. I think that's how the puzzle pieces fit together in a thoughtful way. It provides a really important part of the market for flex operators. And I think it also then creates a much needed opportunity at this part of the market cycle, given the fact that we still are facing a lot of headwinds to experiment with some of these management agreements and to allow the flex to thrive in the way that it can in being more of a consumer product than what landlords have always offered to the market of take it or leave it. Here's your warm lit shell. You're going to sign a 10-year lease, and you're going to, you know, put a personal guarantee on, and it's a different environment right now. And
Yeah.
I think it should be a different environment, and I think it'll be better for it'll be better for everyone.
All right. So to summarize, we were both observers of the market in late 2017, early 2018. The view was corporate demand is wanting more amenity, more flexibility, all of those things. That the thinking back then was that we would get there through a combination of co-working and spec suites and things of that nature. But now looking at it, those predictions, and I want your take on this, were based on very low sublease inventory, very low interest rates, both of which would
Mhm.
promote a lot of new development of new product types. Sitting where we are now, maybe halfway there, um, those things are starting to influence the way that we're going to get there. Meaning we're gonna use more second gen or recently renovated or gently used, if we want to use
Yeah,
another,
that's a good one.
you
That's a good one.
know, or we're going to use more of that. Amenity spaces are going to be things that owners are investing in,
Yeah.
but maybe the days of the $250 plus square foot build out funded through a lease to build out a high-end co-working space, that might be the smallest kind of incremental change, at least compared to the others that we're going to see between now and
Hmm.
2030. Is that a good summary?
Yeah,
Anything you'd change?
I think so.
Okay,
I,
fascinating. Well, let's not wait 6 more years to find out. We'll have another conversation hopefully before then. So thanks so much for talking, Scott. I really appreciate it.
Sounds good. Good talking with you, Ben.